Good day, and welcome to the Preferred Bank Fourth Quarter 2020 Earnings Conference Call. All participants will be in listen-only mode. Should you need assistance, please signal a conference specialist by pressing star, then 0 on your telephone keypad. After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star, then 1 on your telephone keypad. To withdraw your question, please press star, then 2. Please note, this event is being recorded. I would now like to turn the conference over to Jeff Haas of Financial Profiles. Please go ahead.
Thank you, Andrew. Hello, everyone, and thank you for joining us to discuss Preferred Bank's financial results for the fourth quarter ended December 31st, 2020. With me today from management are Chairman and CEO Li Yu, President and Chief Operating Officer Wellington Chen, Chief Financial Officer Edward Cheka, and Deputy Chief Operating Officer Johnny Hsu. Management will provide a brief summary of the results, and then we will open up the call to your questions. During the course of this conference call, statements made by management may include forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. Such forward-looking statements are based upon specific assumptions that may or may not prove correct. Forward-looking statements are also subject to known and unknown risks, uncertainties, and other factors relating to Preferred Bank's operations and business environment, all of which are difficult to predict and many of which are beyond the control of Preferred Bank. For a detailed description of these risks and uncertainties, please refer to the SEC required documents that the bank files with the Federal Deposit Insurance Corporation, or FDIC. If any of these uncertainties materialize or any of these assumptions prove incorrect, Preferred Bank's results could differ materially from its expectations as set forth in these statements. Preferred Bank assumes no obligation to update such forward-looking statements. At this time, I'd like to turn the call over to Mr. Li Yu. Please go ahead.
Thank you very much. Good morning, ladies and gentlemen. I'm very pleased to report fourth quarter of 2020, Preferred Bank's net income was $20.8 million or $1.40 a share. This is a new record for our bank. And on the PTPP, a pre-tax, pre-provision basis, 2020 is also a record year of Preferred Bank. This quarter's net income, net interest income, and net interest margin are all enhanced or benefited by two relatively non-recurring items. First of all is the recovery of interest of $473,000. The next one is fees on and now terminated Main Street lending program of $499,000. Net interest margin came in for the quarter at 3.66%, of 12 basis points better than previous quarter. But without these non-recurring items, it would have been 3.58%, 4 basis points better. Again, this quarter, the reduction of interest costs or deposit costs outpaced the moderation of a loan yield. Looking ahead, we shall have continued interest cost saving in the first quarter, as roughly $330 million of time certificate deposits will be repricing for roughly 50 cents or 50 basis points savings. For the quarter, net income was negatively affected by a loss on sale of securities of $660,000. For the quarter, loan growth is $86 million, or 2.2% sequentially. This is very encouraging okay, after a long drought and during the midst of pandemic. Okay. We have seen our customers seem to be much more positive on our nation's economy. Fourth quarter loan booking is really picked up. Deposits, however, grew only mildly at $28 million. And as the liquidity of the bank remained very good. Perhaps the most comforting things to us is the improvement in our credit posture. After nearly years of uncertainty related to the pandemic, we finally see things are getting better. Specifically, deferred loans now reduced to $28 million compared to the peak time of $610 million. Okay? But most of these deferments are partial deferments where we're deferring the principal only and continue to collect interest. Total non-accrual loans now reduced to $20.5 million. 30 to 89 days past due loans, which is usually an early signal on the credit situation, stands at $4.1 million at the end. There were no 90 days past due loans. And total classified loans is now $55 million, which includes a $23 million TDR, which is performing. At December 31st, total reserve is 1.6%. We were and we will always be careful regarding our operating expenses. Efficiency ratio again came in 29.9% for the quarter. With the availability of vaccine, although it is quite a chaotic situation in Los Angeles County, but with its availability and with the likelihood of a stimulus package from Washington, we believe things will be much better. And we believe 2021 will be a good year for Preferred Bank. Thank you. I'm ready for your questions.
At this time,
Operator?
We will now begin the question and answer session. To ask a question, you may press star then 1 on your telephone keypad. If you are using a speakerphone, please pick up your handset before pressing the keys. If at any time your question has been addressed and you would like to withdraw your question, please press star then 2. At this time, we will pause momentarily to assemble our roster. The first question comes from Nick Cucharale of Piper Sandler. Please go ahead.
Good day, gentlemen. Hope you all are well.
Thank
Hello,
you.
Nick.
We are.
Good. So first, a nice rebound in loan growth this quarter, specifically in CRE balances. Was the production broad-based across your geographies? I'm just trying to get a sense if the activity was specific to one of your markets, given differences in pandemic-related impact across the country.
For us, it's all across. But why don't you want to first give some color on that?
Yeah. Hi, Nick. This is Wellington. Production is pretty evenly distributed in our geographical footprints. Of course, Southern California, NorCal, as well as East Coast and New York area. It's very well balanced.
Great. And then secondly, on the margin, I appreciate you calling out the one-time items and the maturity schedule. Even so, you posted core NIM expansion. Do you feel like you still have some room for declining liability costs to outrun erosion in asset yields for the next couple quarters, or is that going to be challenging to maintain?
Yes, there will be liability costs will be generally on a very positive trend. First of all, is the first quarter. We have $330 million of TCD maturing, okay, which will be repriced at probably 50 basis points less, okay. And the second quarter, we may have a little bit of residual effect of the first quarter, but provided the market interest rate doesn't change due to competition, okay. And very highly likelihood we'll be refinancing our sub-debt, okay, at the end of second quarter, okay, which will result, at today's market condition, a reasonably good savings. So we are positive regarding our interest cost outlook.
That's great color. Impressive work on driving the modifications down this quarter. No hotel loans on deferral was especially positive to see. When it comes to asset quality in the current portfolio, what is particularly top of mind for you? What are you guys worried about?
Well, we would be worried about a continuous lockdown to extending to a long time. Mostly that people seeking deferment is many of the people have been digging out of their savings. Especially, we forgot one group of people, those poor landlords, okay, had their property leased to either to people that lost their job or leased to the business that's closed and so on. They have been handling for quite a period of time, okay? And in our particular case, that we're benefited by origination at the low, LTV level. If you look at the table that we're presenting, they're basically in the 50s. Okay? And the second of all, since 95 and 100% of 99% of the loan require a sponsorship, a personal guarantee, okay? And we're very careful about the global cash flow of these personal people. So we have been having some good reduction in across the board all the categories. But the people that still, they have been, the poor people has about 1 year of basically no business. Okay, so some of them finally that needed some help. They've been paying along the way and finally need some help.
Okay. And then lastly, for me, a big step up in fee income from letters of credit. Do you expect that line to stay elevated at this level in coming quarters, or revert back to where it was earlier last year?
We think it's going to be relatively stable, but Ed and then one or two you two can provide the color on that, right?
Nick, I believe that looking at our pipeline about that, I think it'll be relatively stable.
Thank you for taking my question.
The next question comes from Tim Coffey of Janney. Please go ahead.
Thank you. Morning, everybody.
Hi.
Hey, Mr. Yu, we look at kind of the loan growth this quarter. Is that a reflection of people getting off the sidelines and getting back to business, or was this a bit ahead of expectations?
Well, some of the people, I would say there's all kinds. Some of them is getting off the sidelines. Okay, and basically during the pandemic, it's very, very difficult to do business with new people. But we heard and we have seen new requests coming in. And we are still in the mode of being highly alert mode. But there are some new requests coming in that represent new activities to us.
Okay. What does this quarter's loan growth tell us about the potential for loan growth next year as states like California start to reopen?
Well, it is probably. I wish I had that crystal ball. It is always difficult to forecast the loan growth, especially quarter by quarter, if not anything else. But based on the fourth quarter activities, we have booked a total of outstanding loans about $300 million new loans in the fourth quarter alone. And these represents $375 million of note amount, which means the commitment amount. So we hope the effect will carry over for the first quarter, okay? But again, it has factors about when the lockdown will be lifted or partially lifted, because for us, our people need to really have very close contact with our customers. So there's some variables with it, and but we're generally feeling positive about going forward.
And the customers you serve and the loans you like to originate, what's the competition level like right now?
I would jokingly let Wellington answer first. I have some personal observations. Yeah.
Hi, Tim. This is Wellington. I think competition is pretty stiff out there. You know, we have a lot of competitor out there offering very low interest rate. We just don't know how they can sustain that going forward. But again, you know, our workforce, we try to maintain discipline, as Mr. Yu mentioned earlier, be selective and really, just continue. I mean, it's always been the nature of our business throughout the history. So we just have to continue to work faster, more efficient.
Tim, this is Li Yu, okay? We're now facing a whole lot of competition from banks, $50 to $150 million within our territories, okay? That it seems to be that our customers are basically high net worth individuals being sought after, so they can also give other business for them. For instance, that we're finding people that refinance our loan at low 3% 10-year fixed rate.
That's 3%.
Okay, and that is below our net interest margin. Okay, while we are obviously admiring their capability of doing that, there are many loans we decided not to match.
Okay, yeah, that's very helpful, and that is the type of customer I was curious about. And then looking at expenses, if the economy starts to reopen, is there going to be the potential for upward pressure on expenses from additional traveling and marketing?
Hey, Tim, this is Ed. Looking forward in terms of non-interest expense, to the extent profitability improves in 2021 over 2020, you will see the salary and benefits expense increase over the year because our bonus accrual is directly tied to the profitability of the bank, so that will go up. More specifically to your point about reopening and travel costs and so forth, they're really not terribly significant for us as an entire company, simply because our workforce relative to our asset size is still relatively small. So when you look at the line items specifically where we have actually benefited this year, it's in business development and promotion as well as office supplies and equipment. And you'll see those line items actually went down year over year. So that's really where the benefit comes in. But outside of that, there's not a tremendous amount of benefit for us in terms of the lockdown. And then going forward, in terms of increasing non-interest expense with an opening up, we will have some increased expenses, but it won't be material.
Tim, I'd like to also tell you something, okay? That the management team here is in a growth posture again, because we feel pretty good about 2021. So likely we will step up our effort in looking for new locations or new branches and new different things. Okay, so likely somewhere along the year, our personnel expenses will be increasing our production personnel, and obviously those usually lead to, if we're successful, to a larger long-term benefit.
Yes, of course. All right. Well, thank you very much. That's exceptionally helpful.
The next question comes from David Feaster of Raymond James. Please go ahead.
Hey, good morning, everybody.
Hi, David.
I just wanted to follow up on your last comment about new offices, and just curious, are there any new markets that you might be interested in organic expansion into, and just kind of how are you thinking about that in terms of that organic expansion side?
Yeah, first of all, I've always one thing is that, okay, our organic market comes with whether we can land a team of producers. We usually, whenever we found an able banker, okay, then we round him up with a team of supporting cast, then start a business there. That goes along with every branch that we have opened, even in the neighborhood of Los Angeles area. And even consider about the California area. We have so many new spots which are not represented by us, which represent vibrant business centers. Our hard work really is the locating of people. So whenever we see this opportunity, there will be new organic new trees being grown.
Okay. And then in terms of asset quality, I mean, you guys have continued to improve. Your defensive posture has proven itself. We've actually seen the reserve ratio continue to grow. I guess just in light of the improved economic outlook and improved credit quality, how do you think about the opportunity to potentially release reserves, and maybe at what point would you think you'd be comfortable doing so? And then what's kind of like that more normalized reserve ratio? Is it closer to 125, which we saw in the first quarter of 20? Is that kind of where we should be looking at?
Well, I'm looking at the trend, okay? So if asset quality remain, not turning to the worst, okay? I can see, first of all, is a reduction of provision, perhaps very, very minimum provision. And then somewhere along the year, I can see that we may be able to release some of the reserve, okay? But all it depends on how the situation plays out, and also it has to some extent with the growth rate we will have, okay? It also affected the situation. But generally speaking is that based on what we are today at this point in time, I can see the whole year's provision expense will be very little, comparatively speaking.
Okay, that makes sense. And then I'm just curious, historically you guys have been pretty asset sensitive, and I'm just curious how that stands today, just in light of the liquidity and the impact of floors, and maybe how your asset sensitivity has changed, and then just how you are thinking about managing your sensitivity going forward.
Ed, you and I share this question. How's that? Okay?
Sure.
Okay, you start first.
Oh, okay. Well, the interest rate situation is very interesting right now, simply because we have such a divergence between the long and the short end, and the curve seems to be continuing to steepen. But relative to our own balance sheet, you kind of hit the nail on the head. We have a lot of cash, which is very asset sensitive, obviously on an overnight basis, and then the adjustable rate loans. Roughly 80% of the book is floating rate, and so with approximately 70% floors on those, and a number of those, large preponderance of those being below their floors, it will take maybe 1 or 2 to 3. And this is very similar to the scenario we had a few years back when we were talking about the same thing, waiting for rates to rise, and we had loans below their floors, waiting for them to come up above their floors, and then we really saw the acceleration of the yields on the asset side once that took place. But in terms of asset sensitivity right now, from a quantitative standpoint, we're still definitely quite asset sensitive.
Okay. Obviously, at this point in time, the 80% of our, loans with floors, floating rate loans. Okay, many of them are with floors. Okay, so we are operating currently a little bit under floor. Okay, as of under floor, the floor is higher than the coupon rate. Okay, so going forward, if rates is going to change to the upward, I don't know when Fed will do that. Okay, maybe perhaps the first 25 to 50 basis points, we will not see some of our loans rise to the new rate. But on the defensive side, on the offsetting side, we have a large $1.6 billion of TCD portfolio will be gradually pricing, okay, along the interest rate, repricing along the interest rate increase. But the two of them usually offset somewhat to each other. The exact is depend on the timing of whole things. And we have always been, in our history, tried to maintain these aspects very carefully.
Okay, that's helpful. Thanks, everybody.
The next question comes from Steve Moss of B. Riley. Please go ahead.
Good morning.
Hi.
Just start off with, just following up on yields here. Just kind of curious, what were origination yields for the quarter in terms of pricing these days?
Okay. For the quarter, we are originating the loans, okay? In the pricing, I have it handy right with me right now, okay? With the average rate is 4.885%, okay? So the as you, in the same quarter, you have payoffs, okay? Payoffs a little bit higher, about 30 basis points higher. That is one of the main reasons where you have more moderate yield compression,
Okay, that's helpful. And then on the CD side, kind of curious as to where you're offering rates there these days.
Hi, Steve. This is Ed. On a one-year CD, our offering rate is right around 50 basis points. And that kind of holds true down through the 6-month and 3-month probably as well. It's become a market that doesn't care terribly a lot about terms in terms of 1 year, 2 year, 6 months right now.
Steve, if you notice that the first quarter we had lost some TCDs, okay? And that is because we decided not to match those maturing TCDs. The bank is too liquid, in my opinion, at this point in time. And so much cash sitting in earning 10 basis points from Fed, okay? So those are the really more strategic move, kind of thing.
Right. Okay, that's helpful. And then, in terms of capital here, building this quarter, seems like it's going to continue to build in 2021. Just kind of curious as to what your thoughts are on the potential for capital deployment.
First of all, as we continue to earn this kind of a level of earnings, hopefully there may even be slight improvement in sometime in 2021. We obviously will be thinking about increase the dividend. That's almost a thing that we have dedicated that we will recommend to the board. Okay. Now the next thing is obviously, as we're always weighing, is the organic loan growth. Okay. If we have the organic loans, let's say we're lucky enough to return to 2 years ago, getting in the teens, okay? Then the redeployment capital basically will be largely through the using the loan growth in the area. If we cannot have original loan growth, then we will be looking at situation like a buyback, okay? But all this is studying. I'm right now studying what if we have a buyback immediately, okay? What effect would do to us in our current, capital level. You see our primary capital level is slightly over 10%. Okay? So that is one area that we're studying and to see how comfortable we are doing things.
Okay, great. That's very helpful. Thank you very much.
Okay. And this concludes our question and answer session. I would like to turn the conference back over to Li Yu for any closing remarks.
Well, thank you very much for your attention. And as I said earlier, we had a good quarter, and we hope it continues into next year, and hopefully that all of us will be getting out of pandemic soon, and we're back to our normal life, get our freedom back, okay, which is probably more important than the performance of the bank, anything. But so with that, let's wish for the best for 2021. Thank you.
Thank you. The conference has now concluded. Thank you for attending today's presentation. You may now disconnect.